Welcome to Simple Investing Secrets, your trusted source for valuable investment insights, stock recommendations, and strategies to help you achieve financial freedom. In today's video, we'll delve into the 5 401k insights you can't afford to miss. So before we start, we'd like to remind everyone that this isn't financial advice, and if you find value in this video, please support our channel by liking and subscribing to our weekly updates. Now, let's get started. It's indisputable that saving for retirement is not just important, it's paramount. The 401k plan offered by your employer is undoubtedly one of the most effective tools at your disposal for achieving this crucial financial goal. These plans come with higher contribution limits compared to individual retirement accounts, providing you with the opportunity to invest more in your future. Additionally, they offer cost-effective investment options, thanks to economies of scale, making them an attractive choice for savvy investors. The automation feature is another invaluable aspect, making saving for retirement a seamless process. This means you can free yourself from the hassle of manually managing your contributions and ensure a consistent and disciplined approach to building your retirement nest egg. While plan offerings may vary among employers, the fundamental operation of 401k plans remains consistent. Given their critical role in retirement planning, it's not just beneficial but crucial to acquaint yourself with key facts about 401ks. Let's take a closer look at 5 vital points that can significantly impact the effectiveness of your 401k strategy. Number 1. Long-term vision for your 401k. Stuart Sprenger's insights as a senior wealth advisor at Citi Personal Wealth Management prompt us to consider our 401k not just as a financial instrument, but as the bedrock of our lifelong financial security. This holistic perspective calls for an intricate investment strategy, delicately balancing the pursuit of growth with the imperative of stability. Sprenger warns against extremes, steering clear of overly aggressive investment choices during our working years, which could lead to a sudden shift to safer options upon retirement. Instead, he advocates for an ongoing commitment to a diversified portfolio, which may include large company growth stocks, dividend stocks, and other assets resilient against the erosive forces of inflation. While the specific allocation varies based on individual circumstances, the overarching objective remains constant, fortifying ourselves against the persistent adversary of inflation. For your 401k to realize its long-term objectives, time becomes a crucial factor in its growth and maturation. Sprenger emphasizes the importance of resisting impulsive reactions to market news or current events. As Mike Lynch, the managing director of Applied Insights at Hartford Funds, underscores, successful long-term investing hinges on having a robust plan and adhering to it. If uncertainties linger about the adequacy of your plan, seeking guidance from a financial advisor or your company's benefits department becomes paramount. This ensures that your investment strategy aligns seamlessly with your evolving financial goals and circumstances. Imagine you're in your mid-30s and have diligently contributed to your 401k, mainly invested in a mix of growth stocks and index funds. As market volatility peaks due to global events, there's a temptation to shift entirely to safer, low-risk assets. However, applying Sprenger's advice, you decide to stay the course, acknowledging that your 401k is a long-term investment. Consulting with a financial advisor, you reaffirm your commitment to a balanced portfolio that aligns with your risk tolerance and retirement goals. This decision not only shields your investments from knee-jerk reactions, but also positions you for potential long-term growth despite short-term market fluctuations. Number 2. Potential tax credit for contributions. In retirement planning, beyond the familiar tax benefits of employer-sponsored retirement plans, a hidden opportunity lies in the form of the Retirement Savings Contributions Credit, or the Savers Credit. Stuart Sprenger brings attention to this often overlooked gem, designed specifically to provide assistance to low to middle-income individuals actively contributing to their retirement accounts. To be eligible, one must be 18 years or older, not claimed as a dependent on another person's tax return, and actively contributing to a 401k or other qualifying retirement plan. In the tax year 2024, the income thresholds for eligibility are set at $38,250 for single filers, $76,500 for those filing jointly, or $57,375 for heads of household filers. The credit applies to a maximum of $2,000 worth of contributions, or $4,000 for married filing jointly. The credit's percentage varies based on adjusted gross income, with potential rates of 50%, 20%, or 10% of your contribution. This translates to a maximum tax credit of $1,000 or $2,000 for married filing jointly. Consider a scenario where you, as a single filer, earn $35,000 annually. By contributing $2,000 to your 401k, you qualify for the saver's credit, with an adjusted gross income below the $38,250 threshold. You fall into the 50% credit bracket. This means your potential tax credit is $1,000, effectively reducing your tax liability. This scenario not only illustrates the financial benefit of the saver's credit, but also incentivizes conscientious retirement saving for those within the specified income brackets. Number 3, understand the fees. Navigating the landscape of 401k planning, which promises robust retirement savings, demands a keen understanding of the underlying fees. Stuart Sprenger underscores the nuanced nature of these fees, some overtly visible on statements and account activities, while others stealthily nestled within the expense ratios of underlying investments. This covert inclusion often makes them elusive on regular statements or company websites. The significance of fee awareness cannot be overstated, considering their direct impact on investment returns. Even seemingly inconsequential upticks in expense ratios can compound significantly over time, potentially leading to substantial reductions in your portfolio's value. To put it in perspective, a mere 0.25% increase in expense ratios could siphon off $10,000 from a $100,000 portfolio over 2 decades. In cases where 401k fees prove to be burdensome, savvy investors might find it advantageous to contribute beyond the employer match limit and redirect those funds to a self-directed IRA, boasting a more favorable fee structure. In essence, the crux lies in understanding, taking the initiative to scrutinize 401k materials, delving into the summary plan description, and comprehending the entirety of fees and charges that may impact your savings is paramount. Cultivating fee awareness emerges as a pivotal step in refining and optimizing your 401k strategy, ensuring that your hard-earned money works most efficiently toward your retirement goals. Imagine a scenario where an investor, Jane, diligently contributes to her 401k without a thorough understanding of the associated fees. Over time, the impact of seemingly minor fees erodes a significant portion of her returns. As Jane becomes fee-aware, she decides to explore alternative investment options with lower fees, subsequently redirecting a portion of her contributions. This proactive approach not only preserves more of her earnings, but also positions her for enhanced long-term growth. Number 4. Autopilot isn't always the best strategy. While the allure of automation is undeniable, blind reliance on autopilot features may not align with your best interest, particularly when defaults in investment options and savings rates are involved. David Blanchett, a thought leader in retirement research, sheds light on the prevalent use of defaults in 401k plans, especially concerning investment choices and savings rates. The default investment option often features a target date fund, a generally prudent choice according to Blanchett. However, the default savings rate, typically set at 6% or less annually, may fall short of providing the financial security necessary for retirement. Blanchett advocates for a more comprehensive savings approach, urging individuals to aim for a total savings rate, including both deferral and employer contributions, to be at least 12% of their income. While achieving this target immediately may pose a challenge, Blanchett recommends a gradual increase over time. Think of Mark, a young professional, automatically enrolls in his company's 401k plan with the default settings. As he becomes aware of the default savings rate, he decides to proactively reassess his contributions. Mark opts for incremental increases, adding an extra 1% each year, gradually progressing towards the recommended 12% savings rate. This strategic adjustment ensures that Mark's retirement contributions align with his long-term goals without causing a significant impact on his current budget. Number 5, consider a Roth 401k. Mike Lynch emphasizes the enduring importance of tax diversification, likening it to investment diversification. For those harboring concerns about potential increases in future tax rates or aspiring to access tax-free income during retirement, the option of making after-tax Roth contributions to a Roth 401k is worth serious consideration, where available. Much akin to Roth IRAs, Roth 401ks operate on the principle that the contributed money is not tax-deductible at present. However, in exchange, withdrawals can be made tax-free in retirement. Stuart Sprenger introduces a nuanced perspective, asserting that the choice between traditional and Roth 401ks hinges on a thorough understanding and comparison of the immediate tax benefits against the post-retirement tax advantages. This decision should align with one's unique financial needs and circumstances. Generally, Roth 401ks find resonance with younger investors possessing lower incomes. These individuals may not necessarily require the immediate tax break offered by a traditional 401k, and can leverage the benefits of long-term tax-free growth in a Roth. Conversely, investors with higher incomes or those nearing retirement might find the traditional 401k more advantageous. Ross Mannino, a seasoned Ameriprise private wealth advisor and managing director with Wealth Planning Strategies, underscores an additional avenue for high-income earners, after-tax contributions, often referred to as a backdoor Roth. This means that even if an individual has maximized their contributions to traditional or Roth 401k for the year, they can still make non-deductible after-tax contributions. However, it's imperative to stay within the annual limit of $69,000, combining both employee and employer contributions in 2024. A crucial caveat is that if one opts for after-tax or Roth 401k contributions, the employer match contributions will remain pre-tax. Consequently, taxes will be levied on this money upon withdrawal during retirement. Despite this, David Blanchett accentuates the value of saving at least a little bit in a Roth as a strategy to introduce tax diversification into one's overall savings portfolio. This deliberate approach enhances the flexibility and tax efficiency of your retirement savings, aligning with a comprehensive financial strategy. Imagine Emily, a mid-career professional contemplating her retirement savings strategy. Aware of potential future tax implications, Emily decides to diversify her tax exposure by allocating a portion of her contributions to a Roth 401k. This strategic move not only positions her to potentially enjoy tax-free withdrawals in retirement, but also aligns with her long-term financial goals, providing a layer of flexibility amidst the ever-changing landscape of tax regulations. Understanding the intricacies of your 401k is not just beneficial, it's essential for optimizing its potential. By adopting a long-term perspective, exploring tax-saving opportunities, staying fee-aware, taking a proactive savings approach, considering tax diversification, maximizing employer match opportunities, and regularly reviewing your portfolio, you can navigate the complexities of your 401k with confidence. If you found this information valuable, don't forget to give the video a thumbs up, subscribe for more insightful content, and hit the notification bell to stay updated with our weekly releases. Thank you for joining us at Simple Investing Secrets, where financial empowerment begins.